Dear 4th grade students at the Department of Economics, this is our third recorded lecture for the module entitled Economics of Investment and Financial Markets. In the current lecture, we start studying Chapter 4 of Mishkin and Eakins 2012. The chapter is concerned with explaining why interest rates change. The current chapter covers the following points. First, determinants of asset demand. Second, supply and demand in the bond market. Third, changes in equilibrium interest rates due to shifts in the demand for bonds and shifts in the supply of bonds. We start the current presentation by discussing the determinants of asset demand. This is followed by analyzing the supply and demand in the bond market. Finally, we conclude. An asset could be defined as a piece of property that is a store of value. There are four primary factors that influence people's decisions to hold assets. These factors are wealth, expected return, risk, and liquidity. You already know the definitions of these terms from the current course and from previous economic modules. However, let me remind you of their definitions. First, wealth could be defined as the total resources owned by the individual, including all assets such as houses, farms, and equipment. Second, expected return is the return expected over the next period in one asset relative to alternative assets. The expected return on an asset is computed as the weighted average of all possible returns, where the weights are the probabilities of occurrence of that returns. Third, risk could be defined as the degree of uncertainty associated with the return on one asset relative to alternative assets. The standard deviation of returns on an asset is used as a measure of its risk. Finally, liquidity is the ease and speed with which an asset can be turned into cash relative to alternative assets. Now, let's briefly discuss how these factors affect the quantity demanded of an asset. Table 4.1, which is displayed in the current slide, summarizes responses of quantity demanded due to changes in these factors. With regard to wealth, holding everything else constant, an increase in wealth raises the quantity demanded of an asset and vice versa. Concerning expected return, holding everything else unchanged, an increase in an asset's expected return relative to that of an alternative asset raises the quantity demanded of the asset and vice versa. With respect to risk, holding everything else constant of an asset's risk rises relative to that of alternative assets. Its quantity demanded will fall, and vice versa. Finally, and regarding liquidity, holding everything else unchanged, the more liquid an asset is relative to alternative assets, the more desirable it is, and the greater will be the quantity demanded of it, and vice versa. We now turn our attention to the analysis of interest rate determination. This is done through studying the supply of and demand for bonds, taking into consideration that rates on different securities tend to move together. The current chapter acts as if there is only one type of security and a single interest rate in the entire economy. The first step in the analysis of interest rate determination is to obtain a demand curve for bonds. This demand curve shows the relationship between the quantity demanded of a bond and its price when all other economic variables are held constant. Our task now is to drive the demand curve for a 1-year discount bond with a face value of $1,000. In this case, the return on this bond is entirely determined by its price. The return in this case is the bond's yield to maturity, and it is equal to the interest rate. Hence, we could use equation 6 in chapter 3 to compute the expected return on this bond. This equation is shown below. It tells us that a particular value of the interest rate corresponds to each bond price. Let's assume that the bond is sold for $950. The interest rate is computed according to the above formula. It equals to 5.3%. Assume that at this price the quantity demanded is 100 billion bonds. Let's call this point A. Now, what would be the interest rate and the quantity demanded of bonds if the selling price of this discount bond is $900, $850, $800, and finally $750? Actually, the answer to this question is quite simple. We are going to use the above formula to compute these interest rates. By employing the formula mentioned in the previous slide, we obtain the interest rates shown in the third column with the attached table. Note that corresponding to each price and each interest rate, the quantity demanded is attached. The question is, how do we know the quantity demanded of bonds at each price and interest rate? The answer is simple. We are just making up those numbers, but we are applying basic economics. Let me explain. We assume that all other economic variables are held constant. These variables include income, expected returns on other assets, risk, and liquidity. Now, as the expected return on these discount bonds increases, more people will demand it. Remember that the expected return for a 1-year discount bond is its yield to maturity, that is the interest rate. Because the expected return on these bonds is higher, the quantity demanded of bonds will be higher, as predicted by the theory of asset demand, as we mentioned in the starting of this presentation. Point B in the attached table shows that the quantity of bonds demanded at the price of $900 has risen to $200 billion. Let's continue with this reasoning. If the bond price is now $850, the quantity of bonds demanded at point C will be greater than at point B, and so on. If these points are plotted on a figure and connected with each other, the resulting curve is the demand curve for bonds. Figure 1 displayed in the current slide shows that the demand curve for bonds has the usual downward slope, indicating that at lower prices of the bond, everything else being equal, the quantity demanded is higher. An important assumption behind the demand table and the demand curve for bonds shown in the previous slide is that all other economic variables besides the bond's price and interest rate are held constant. Now, we are going to use the same assumption in driving a supply table and a supply curve for bonds. Both the supply table and the supply curve show the relationship between the quantity supplied of bonds and its price when all other economic variables are held constant. Table 2 attached here tell us that if we are at point F when the price of the bonds is $750 and the corresponding interest rate is 33%, the quantity of bonds supplied is $1 billion. If the price of the bond rises to $800 and the corresponding interest rate declines to 25%, then the quantity supplied of bonds will jump to $200 billion as represented by point C in the table. Why does the quantity supplied increase? This is because at this lower interest rate, the cost of borrowing decreases, and thus firms are willing to borrow more through issuing more bonds. Thus, as the price of the bond increases and its corresponding interest rate decreases, the quantity supplied of bonds rises. Again, like the demand curve, we are just making up those numbers, but we are applying basic economics. That is, more people will offer the bonds if the expected return is lower. Note that the expected return equals the interest rate, which is the yield to maturity. Now, if points of table 2 are plotted in a figure and connected with each other, the resulting curve is the supply curve for bonds. Figure 2 displayed in the current slide depicts this supply curve. This supply curve has the usual upward slope found in supply curves, indicating that as the price increases, everything else being equal, the quantity supplied increases. As you already know, in economics, market equilibrium occurs when the quantity demanded equals the quantity supplied at a given price. In the bond market, this is also achieved when the quantity demanded of bonds equals the quantity supplied of bonds. In the example under consideration, and as shown in figure 4.1, equilibrium occurs at point C. At this point, the demand and supply curves intersect at a bond price of $850. This price is corresponding to interest rate of 17.6% and a quantity of bonds equals to $300 billion. Hence, the equilibrium price, or what is known as the market clearing price, is $850. Similarly, the equilibrium interest rate, or what is termed as market clearing interest rate, is 17.6%. If the price of bonds is set too high, at say $950, the quantity supplied of bonds at point I is $500 billion. At this high price, the quantity demanded of bonds at point A is $100 billion, which is lower than its corresponding quantity supplied. Thus, the bond market experiences excess supply. At this high price, people want to sell more bonds than others want to buy. Therefore, the price of the bonds will fall. This explains why the downward arrow is drawn in figure 4.1 at the bond price of $950. As long as the bond price remains higher than the equilibrium price, there will continue to be an excess supply of bonds and the price will continue to decline. This fall in price will stop only when the price has reached the equilibrium price of $850. At this price, the excess supply of bonds has been eliminated. Assume that the price of bonds is set very low at say $750, which is below the equilibrium price. At this low price, the quantity demanded at point E is $500 billion, whereas the quantity supplied at point F is $100 billion. Given that the quantity demanded is greater than the quantity supplied, then the bond market suffers from excess demand. Now, people are willing to buy more bonds than others are willing to sell. Hence, the price of bonds will be driven up. This is shown by the upward arrow drawn in figure 4.1 at the bond price of $750. As long as the bond price remains lower than the equilibrium price, there will continue to be an excess demand of bonds and the price will continue to rise. This increase in price will stop only when the price has reached the equilibrium price of $850. At this price, the excess demand of bonds has been eliminated. The current presentation covered two issues of chapter 4. In the first point, we concluded that there are four factors affecting the demand for assets. We found that the quantity demanded of an asset is positively linked to wealth, the expected return of this asset relative to alternative assets, and its liquidity relative to alternative assets. In contrast, the quantity demanded of this asset is negatively related to the risk of its returns relative to alternative assets. The second point covered in the current presentation is the analysis of the interest rate determination through studying the supply of and demand for bonds. This determination is derived based upon the assumption that there is only one type of security, that is the discount bond, and a single interest rate for the entire economy. The demand curve for bonds has the usual downward slope, implying that at lower prices of the bond, everything else being equal, the quantity demanded is higher. In contrast, the supply curve for bonds has the usual upward slope, implying that at higher prices of the bond, everything else being equal, the quantity supplied is higher. The market clearing price is the price that equates the quantity demanded of bonds and the quantity supplied of bonds. Similarly, market clearing interest rate equates the quantity demanded for and the quantity supplied of bonds. At a price higher than the equilibrium price, the bond market suffers from excess supply. In contrast, at lower prices than the equilibrium price, the bond market suffers from excess demand. These imbalances are eliminated through the price mechanism in which the bond price adjusts to restore the market equilibrium. Now we have reached the end of our lecture. Thank you so much.